Welcome, everyone, and thank you for joining us. I'm Faith Larson, Vice President of Renewables and Legal Counsel for Mickelson & Company. Today, we're going to discuss transferability and ways to mitigate risk when considering the purchase of a transferable tax credit. Before we begin, I'd like to mention that we will have a Q&A at the end of the webinar. So if you have any questions, please add them in the Q&A and we'll ensure to get to them as time allows. Also, a recording of the webinar will be available after if anyone is interested. So I'd like to move on and introduce our panel of esteemed colleagues who so willingly agreed to share their insights and experience. First, we have Brandon Hill. Brandon is a tax principal with CliftonLarsonAllen's Federal Tax Strategies Group and leads the Energy Services team. He brings over 16 years of public accounting and renewable energy industry experience. Marc is a Senior Vice President with Aon's M&A Transaction Solutions Group. In his role, he's responsible for structuring, brokering, and marketing tax insurance products with a focus on renewable energy tax credits. Turning it over to our Husch Blackwell crew, Andrew Eastman is a partner at Husch, where he co-leads the firm's energy tax credit practice. He is a member of RNG Coalition's Renewable Fuels Advisory Board, Tax Committee, and Legal Committee. Doug Jones is also a partner at Husch, where he counsels businesses on complex tax structure and assists renewable energy developers. He is also a co-lead of the firm's tax credit practice. All right, before we get started, I would like to set the scene and just talk very briefly overall about the transferable tax credit market. So there are really kind of two buckets of renewable energy transferable tax credits. We have investment tax credits and we have production tax credits. Investment tax credits are really one-time transactions based on a energy property, we often refer to it as, or an energy project that is generating the tax credit. There is really a percentage of tax credit available based on really that energy project's cost, or what we often refer to as eligible spend or a qualified basis. That percentage range is really between 6 and 50% of that project cost, depending on whether certain criteria are met. There is a 5-year operating requirement with investment tax credits, and we often refer to that as a recapture period. That means that that energy property or project needs to continue to operate for 5 years from when it's placed in service and meet certain requirements. So we often say there is a 5-year period where if something happens with that project, we have a recapture risk where the IRS can come in and disallow the credit or a portion of the credit. These tax credits often have protections to mitigate against that, which we'll go into further in the webinar. That's with an indemnity, oftentimes a guarantee over the indemnity, or a tax credit insurance policy. Certain examples of these credits are battery storage, solar, geothermal projects, and combined heat and power. We also have production tax credits, which are based on production of a unit of energy or a production tax credit. So they're earned upon that production. We have the advanced manufacturing 45X credit. We also have a 45Z clean fuels credit. And we have our 45Y, which is transitioned into a 45 transitioning into a 45Y for the generation of clean power, whether it's through wind or other sources. So that's a high-level overview of the types of tax credits that we're talking about here today. And as we go through the webinar, whether you're a seller or a buyer, but if you're here attending to consider whether or not a tax credit transfer makes sense for you, there are some key themes that you'll hear throughout the course of this webinar. What are buyers really looking for or considering when considering a tax credit transaction? Flexibility. So flexibility in timing for funding. Buyers are looking to purchase and fund a tax credit at a time that makes the most sense for them and brings favorable economics, or at a time when they're making an estimated payment, as an example, set to pay the IRS anyway. For production tax credits, many buyers who can more easily forecast future tax liabilities have an ability to enter into the same arrangement on a multi-year basis with the generator of a tax credit. This can reduce legal expense, due diligence time, and resources, and provide a long-standing relationship. The utilization of advisors, which is also our panelist today, is very common. Whether it is your CPA helping on tax guidance or external legal counsel to help with due diligence or negotiating your tax credit purchase agreement, these advisors can assist in the entire process and with the diligence and participate in the transaction to offset some of the need for resources. Another theme is the concept of indemnity. These transactions do provide for a seller or the generator of the credit to indemnify a buyer. And that indemnity is really based on the creditworthiness or strength, financial health of the seller of the credit, or whether tax credit insurance is available to cover that indemnity. At the end of the day, buyers are looking for a great opportunity to help lower their effective tax rate, but are not willing to take any type of risk from a disallowance perspective with the IRS. So we need to make sure that we've underwritten the tax credits and have deployed these mitigation strategies to ensure that we've mitigated our risk as much as possible. Buyers also, when we think of production tax credits, do have the ability to fund or purchase credits on a production schedule or basis. And buyers are comfortable to go ahead and fund certain amounts of production and utilize those credits before a full tax year is complete. And there are ways to mitigate risk around that too. Some buyers, when they're new to transferable tax credits, elect to purchase maybe a smaller tax credit to get started and to become comfortable with transferability before they may purchase a second to really fulfill their tax capacity. And finally, it is a market and acceptable that any buyer of a credit may ask the seller for some third-party advisor fee reimbursement, capped at a certain level to help cover these external costs, whether with external counsel or CPAs or third-party advisors. And finally, just a high-level market summary. This is a market that will likely exceed $50 billion in transferable tax credits in 26. And while we do have quite a supply of transferable tax credits, we saw a little bit of compression in pricing at the end of 25 and really into the first quarter of 26. We expect pricing to be stable, and pricing is still dependent on a number of factors, whether the seller is investment grade or does have strong financials for an indemnity or a tax credit insurance policy. The size of the credit impacts the pricing on the credit. So there are lots of nuances around pricing, but we do expect pricing to remain attractive and stable as we proceed in the 2026 tax year. And so with that, why don't we really start this process by looking at first, what is the risk we're trying to protect against? So Brandon, when a buyer has purchased a tax credit, what should they expect from the IRS? Can you talk about the potential for audit and disallowance risk? And what does that process look like?
Yeah, thanks, Faith, and great to be with everyone today. So maybe just taking a quick step back and touching on that summary that you gave, kind of the differences between the two main buckets of credits, kind of ITC versus PTC. So in general, most of our CLA buyers, when they're evaluating a credit, they're relatively credit type agnostic, right? It's more about what is the overall risk profile of the seller. In particular, if there's going to be a tax insurance policy that's kind of attached to a potential ITC transfer. Obviously, from a risk profile perspective, in general, right, the market views PTCs as a little bit, quote unquote, less risky because that recapture risk is not present. However, most of our buyers get pretty comfortable with ITC transactions when there is an insurance policy that kind of assists with covering that recapture risk. So in general, right, there might be some buyers that say, hey, we really only want to deal with PTC transactions, but there's a pretty robust market for both. We don't particularly view a tax credit purchase to a buyer as potentially necessarily opening up additional audit risk just because of the mere fact that you purchased a credit. Obviously, the great thing about the diligence process, right, is that you're going to have a nice supporting file in the event there is an audit to support that tax credit process, right? As every part of tax credit deal, we're always going to have a diligence period where eligibility for the credit is analyzed. The actual tax credit amount itself is analyzed. So in the ITC context, right, we're going to be looking at prevailing wage for the bonus adder. We're going to be looking at the additional bonus adders. You're going to be looking at ITC eligible basis. Was there a step up related to the transaction? All that's going to be looked at, analyzed, and documented as part of the transaction. From a PTC perspective, very similar, right? If prevailing wage is applicable, we're going to be looking at that. You're going to be looking at the production data and kind of underlying materials to make sure that that overall calculation from a PTC perspective is whole. So that in the event that the buyer does get audited, right, there's a nice file that can be presented to the IRS to support the ultimate tax credit amount claimed. There's also a strategy that I think most folks on the call are aware of, that most of the credits, right, if not all, have a 3-year carryback option. So some purchasers will purchase a credit, apply it to that current year return, and then file a carryback to the preceding 1, 2, or 3 years to potentially try to recoup prior year taxes paid. In general, if that carryback is over $5 million, it can potentially implicate the Joint Committee on Taxation review. And so while that may not technically be a quote unquote full-blown audit, right, there could be some additional scrutiny by doing that kind of carryback claim and asking for a refund from the IRS. Taking a step back from a policy perspective, right? If you think about why there was even transferable tax credits created under the Inflation Reduction Act, right? From a policy perspective, they wanted to increase additional capital into the renewable energy space. So it would certainly have a chilling effect if, for whatever reason, the IRS then tried to, intentionally kind of counteract or attack tax credit transfer transactions. So the good news is the way the market's developed, the fact that on pretty much every transaction, there's going to be kind of reputable accounting firms, insurance companies, and law firms. Most every deal that we've been a part of, there's been very solid documentation so that in the event that the IRS has questions, that information's there to kind of readily answer. We have seen a couple instances where IDRs have been issued related to purchases. They've been relatively what I'll call standard in terms of around eligibility, tax credit computation. And again, the underlying supporting documentation has been provided around those. So obviously, audit risk is something that all CFOs, controllers, and CEOs for purchasers ask about. And I think the short answer is, as long as you have proper diligence and documentation, you'll be in a good spot if and when that IRS audit actually occurs.
Marc, prior to joining Aon, you were an attorney specialized in tax controversy. From your perspective, what are the range of risks that should be considered the most based on your prior experience?
Yeah, thanks, Faith. It's always dangerous trying to spec out what the IRS is going to attach to. But historically, what the IRS likes to look at are things that have objective standards to audit. So you're not going to see things like placed in service dates would be a big audit target, because that's just a timing issue for the amount of credits that you're going to get. So in an ITC context, I think you should expect to see things like, is the basis of the project, that is the credit bearing aspect, going to be respected by the IRS. In a PTC context, there's often a fair amount of calculations about how you've generated that pool. Take the 45Z credits, for example. There's an engineering aspect of your carbon intensity scoring. Those types of quantitative metrics are the things that you should expect to see scrutiny on. And so the beauty of tax insurance that it covers those things, and also all of the other aspects that Brandon talked about, which is supposed to give you a fair amount of confidence that regardless of what the IRS attaches into, you're going to have coverage for any of those risks there. And I'll be talking about tax insurance in depth later in this program.
Thanks, Marc. So Both sellers and buyers have strategies that they can deploy to mitigate risk in the tax credit transfer process. So why don't we start with the seller? Andrew and Doug, from your perspective, what are some key strategies a seller should utilize right out of the gate to ensure that their credit has minimized the risks of any potential disallowance? Oh, Doug, you might be muted. If you could check.
Sorry about that. Glad to be here, everyone. So from the seller perspective, really what you're trying to do is get in front of the buyer's diligence. And you want to get them comfortable, and likely you want to get them comfortable as quickly as you can so your deal can get done. So some of the things to be considering, I mean, obviously what the overarching question is the credit eligible? Will it offset tax liability? And there's a lot of factors that can go into that. Some of the ones that are worth keeping in mind from the seller perspective, first are the at-risk financing rules. So with ITCs, certain types of financing can result in a reduction of the basis of the project, which then directly translates into a reduction of the amount of credit. Now, we don't have time to go all the way through the at-risk financing rules, but basically you need to have qualified financing from a qualified lender, and it needs to be recourse. But that's not the important part. The important part is what happens if you get that wrong. If you get that wrong, you could end up with an adjustment to the basis of the project, and therefore to the credit, and that's something you would have to indemnify the buyer for. We're going to talk about indemnities under the agreement later, but generally, sellers are standing behind the credits and saying, yes, this credit will offset your tax liability, and if it doesn't, we're going to make you whole. So those at-risk financing rules are important, and generally best to be avoided if at all possible. They can cause headaches if you have some, and then if ownership changes or the financing changes, it can create problems. So aside from that, again, the exercise is to come to market with a package that's going to make buyer comfortable. So you are going to be showing them documentation and records which support the eligibility. And this will include things like the adders. So prevailing wage and apprenticeship obviously is a very important adder. It gets you a 5x multiplier. The way the market is working right now is that typically people want to look at a report from a PWA service provider who can run a report and say, okay, you've paid the wages that you need to pay, you've used the apprentices that you need to use, and if there is anything that need to be cured, here's what it is. You can make your cure payment, and your credit is eligible for the 5x multiplier. If you have a project which involves domestic content, there are several notices dealing with how you substantiate your domestic content percentages, and there are safe harbors that can be used. These safe harbors make sellers' life a lot easier, and they make buyers' life a lot easier to diligence the project. So you'll need to have those certificates and sort of analysis on why you qualify for domestic content when you're ready to proceed to diligence with your buyer. And then the same will be true for FIAC. Not all deals in the credit marketplace are subject to FIAC. Eventually they will be. There's still some non-FIAC deals out there. FIAC deserves its own hour on a webinar. But we do have some guidance on FIAC. And like the domestic content guidance, we have some safe harbors that we can use. So again, sellers, to the extent their projects are subject to FIAC, will make their lives a lot easier by using these safe harbors, and it's also going to be, again, easier to diligence the project. So in addition to the adders, there's also basic things which go into every single eligibility analysis. One of those is, when was the project placed in service? So this is a term of art in the tax world. It just means the project is in place and is ready to perform its assigned function, design function, and things like permits, your permission to operate and inject notices. If you had an EPC build a project for you and there is a handover certificate, performance test results, and production reports are all helpful to have. And sometimes, especially if sellers are procuring tax insurance, they'll also have an accounting or legal opinion discussing eligibility broadly, and that almost certainly will discuss the placed in service date. Next slide, please. Another one to keep track of, aside from the placed in service date, is the beginning of its construction date. There have been some changes relatively recently with respect to beginning of construction and what counts and what doesn't. As of now, the standard for most new projects is physical construction of a significant nature. Historically, and for some smaller projects going forward, there is a safe harbor where you can spend 5% of the project cost and consider your project to have begun construction. But again, this is going to be part of the package that you're putting together. It's going to include your vendor and contractor certificates, your purchase orders, photographs of the work that was done. If there's a foundation being poured, you take a picture with a timestamp date on it, and then you can show physical work began on this date. And again, these may be supported by legal and accounting opinions.
I've got this one, and thank you. I'm glad to be here. And I want to stop for just a minute and point out that a lot of what we've been talking about is sellers getting ahead of buyer diligence. But there's also a world in which, and a lot of these credits are transacted, there's also a world in which the credit isn't transacted because seller has got tax capacity or tax liability to use it itself, or seller's got an owner somewhere in the ownership structure and seller can allocate that credit and that owner's got the capacity to use it. And so part of this, think about on the seller side, not just getting ready for buyer diligence or getting ready for audit support, but also getting ready essentially for investor diligence. If an investor anticipates having this credit allocated, or paper in the file on behalf of the project owner itself for any future IRS scrutiny if you're going to use the credit yourself. So, whether you plan to transact or not, these are good and worthwhile things to go through. So a couple of other points about how does the seller sort of set the stage to bring in a buyer or to protect itself in the event the credit's going to be used. One of those is that Doug mentioned the vendor and the contractor agreements, and those agreements having requirements to give you certificates that begun construction happened on a certain date, that placed in service happened on a certain date, give you evidence of those things having happened. Keep in mind that all that should be backed up with indemnity. If your contractor is required, your EPC contractor is required to meet prevailing wage and apprenticeship criteria and doesn't, there needs to be an indemnity to back that up. There's oftentimes a cure option there provided by tax law, and so there needs to be a requirement that they're going to pay that cure and they're going to timely do it. That they're going to timely request qualified apprentices and so forth, in the event they can't get apprentices. And all of that should be in the contract or the vendor contract. That addresses bullet 2, their contractual PWA cure requirements. Your vendor and your contractor giving you these indemnities is really only as good as the amount of cash that the vendor or contractor has to satisfy an indemnity. So take a look at your vendor or your contractor's financials. I'm not saying everybody, maybe not the electrician, but the EPC contractor, those who are going to owe you the big ticket indemnity items, take a look at their financials. If you don't like the financials, talk about a guarantor and look at the guarantor's financials. When all else fails, look for your vendor or contractor to have good, strong contractual liability insurance. Make sure that either it's going to cover these indemnities, or if not, know that so that you know you really are relying on the financial strength of either the contractor or its guarantor. One of the things that sort of gets lost in the shuffle, I think, sometimes in working through the diligence of a tax credit, and this applies whether you're a seller who's going to buy the credit, your buyer is going to sell it, buyer is going to buy it, or you're a seller, investor is going to use it, is to look through third-party financing. And Doug mentioned the at-risk rules. You know, and another aspect of third-party financing, in addition to the at-risk rule, is that any third-party lender, you know, without a doubt is going to have a security agreement. They're going to have a security interest in collateral, which is probably the project and project revenue, and maybe the equity interest of the project owner or project company. And so you're going to be looking for a forbearance agreement from that lender, saying that essentially during the recapture period, and again, if we're talking about an ITC that's subject to recapture, that lender isn't going to foreclose, because that would cause a recapture. In the early days of these deals, lenders would raise an eyebrow and say, why in the world would I give up my primary remedy in the event I'm not paid under my loan? The answer typically is that in a direct transfer deal where the credit is being sold, a lot of the proceeds are going to be used to pay down that loan. And so it's in the interest of the lender to let the sale happen so the lender can get part of the loan paid down. The other sort of ancillary part of that is that in security agreements and collateral agreements, when a lender is doing project finance and lending to a project, you know, I mentioned security agreements and collateral. Oftentimes the collateral is written broadly enough, or the security agreement is written broadly enough, or the UCC financing statement is written broadly enough that it covers quote unquote all assets of the project, all assets of the seller, and so forth. More likely than not, all assets includes a tax credit. And so when this thing is generated before it can be used or sold, sometimes you look back at that and think, you know, oh goodness, I really don't have title to this thing to use it or sell it, because it's subject to this very broad collateral agreement or security agreement. And so as part of diligence, go back and look at your financing documents, see what the security interest is in. It's not unheard of to go back and get tax credits carved out so that they can be transacted without any cloud on them. Can I get the next slide, please? And then finally, the thing we all keep circling back to, tax credit insurance, especially if you're going to sell it and it's an ITC, especially, you know, and also if you're going to use it. Sometimes an investor looking for a credit to be allocated is going to look to see whether there's insurance and is going to be enticed if there is. So you're the seller and you're going through the tax credit insurance process. What are you looking for? You know, the basic assumption, or rather the basic goal, is you're going to expand your covered tax position. The covered tax position is the list of things that if they prove false, insurance is going to pay out. The basic ones, and these change deal by deal because sort of deal specific risks come up, but the basic ones, the placed in service date is going to be respected by the tax authority, the IRS. The begun construction date is going to be respected. The tax credit rate is going to be respected. Sometimes the policy will walk through the different categories of tax credit valuation. The credit is worth this much. You get the PWA multiplier. Now it's worth this much. There's a domestic content adder. It's worth this much, and so forth. If there's sort of trouble with that, you know, one end round and sort of shortcut is just to take what you think is going to be the final tax credit rate and hopefully get coverage at that rate is going to be respected. Cost segregation reports, appraisals, especially in an ITC project, that the value of the ITC is going to at least equal the eligible basis shown in the cost seg. That's typically a covered tax position in an ITC deal. Adders and multipliers, you know, if you don't get the overall tax credit rate covered, get the individual adders and multipliers covered. Separate facility treatment. There are different rules having to do essentially with co-located projects or projects that share facilities. It comes up often in a combined heat and power project. And there is a risk that if those are treated as a combined project instead of separate facilities, there's a greater reduction amount that's going to apply. And so from time to time it comes up, and it's something to keep in mind if you're dealing with co-located facilities or facilities that have rather projects that have shared facilities, to push for separate facility coverage. That if the IRS ever comes knocking and says, we disagree, we think these are a combined facility, that the insurance is going to cover that. Negotiate decreased exclusions. That's sort of the flip side of the same coin. The exclusions are things which, if they are true, the policy will not pay out in relation to. Try to decrease those, try to narrow them. One way to decrease them and narrow them is to throw in, if you can, insurer prejudice requirements, meaning if this exclusion happens, it doesn't get the insurer out of paying. It only gets the insurer out of paying if that thing happens and the insurer has been materially prejudiced by that thing happening. And more often than not, you can negotiate for the insurer to bear the burden of proving that it has suffered some material prejudice. It is a quick note on tax credit insurance. Those policies are surprisingly negotiable. I think always of my car insurance and how State Farm just handed that to me and said, take it or leave it. And I really didn't have any say so about it. Compared to that, a tax credit insurance is just, worlds apart in terms of insured value and complexity, and yet surprisingly negotiable. So don't go into these or think about tax credit insurance as a take it or leave it thing. They are very capable of being tailored to a particular project and its particular risk. Next slide. Thank you.
All right. Brandon, turning it to you. You represent and advise many buyers who purchase transferable tax credits. How do you advise your clients on risk mitigation and ways to protect themselves in these transactions?
Yeah, so I think, as we kind of talked about, when we talk with a lot of CFOs and other buyers out there, after they hear about kind of a tax credit purchase opportunity, the most common question is, this sounds too good to be true. What's the catch of being able to buy a tax credit at a discount, right? Well, there isn't really a catch. However, the qualification is that it comes with doing proper due diligence on the tax credit. I think everyone probably understands the common theme now where there actually is incentive for both seller and buyer to kind of collaborate together, right? And kind of work together on getting proper diligence, because obviously if you can de-risk the transaction, not only is that good for the buyer, but it's good for the seller as well. So what we've done here is kind of, and again, we've touched on these a little bit already, is kind of put the risk mitigation buckets into 3 different categories. One is recapture or structure risk. The other is essentially basis risk. And then the last one is the kind of eligibility and qualification risk. Now, for each of the different tax credits, right, whether it's an ITC or PTC, those might have a different flavor, right? And you might approach them in a different manner, but it is important to be thinking about it based off the type of transaction that you might encounter. So the first one, recapture or structure risk, right? So that's going to be most prevalent, right, with our ITC transactions. So in a super simple example, right, if a developer builds a $100 solar project, a large portion of those costs are likely going to be eligible basis for the credit. So if it's cost the developer $100 to build the project, maybe 95, or even for some smaller projects, maybe even all $100 could potentially be eligible basis per that cost seg that Andrew mentioned earlier. As part of that diligence, though, we want to look at that basis to make sure that all of those costs included are actually eligible for the applicable credit percentage, whether that be 6, 30, 40, or 50%. So having a good baseline and making sure that that cost seg is not aggressive is going to be very important to any buyer. It's the first thing that CLA looks at in any diligence, is getting a hold of that buyer cost seg and making sure that our team kind of agrees with the analysis done there. From a structure perspective, right, it's not uncommon for ITC transactions to have what are called a step-up transaction, where essentially there was some sort of sale or other transaction pre-COD or place in service date that basically stepped the value of the project up to its fair market value. Essentially what that does is it has the effect of increasing the ultimate ITC amount. So if there was some sort of step-up transaction, that is certainly something that our team's going to look at as well, just to ensure sure that it's not a very aggressive position in terms of what the overall project valuation was. If there is insurance involved, that's certainly something that the insurer is going to underwrite and look at as well. Generally speaking, and open to Marc's views on this later, that anything above a 25% step up is going to be having a real difficult time passing insurance muster. And so again, it's just a key consideration to look at if there's ITC and if there's a step up transaction on a credit that we may be purchasing. So for the second category, right, that basis risk that we talked about. So one of the things that the IRS could look at, right, if they challenge a credit is that eligible basis that I mentioned. So essentially, is that total cost in that example that I gave earlier, is that eligible costs, are they truly eligible? In general, there's some pretty good guidelines out there in terms of what's eligible, what's not. Solar is pretty straightforward. There are some other ITCs, especially when we were doing more biogas ITC transactions. There was some relative uncertainty, especially during certain periods of time, in terms of what eligible biogas property could be eligible basis. So there will be some gray areas, though. And so while there are general guidelines, it is important to look at and analyze, especially if it's a significant cost, right? So if it's a gray area, it was a significant spend, and it's being included as eligible basis, certainly want to make sure that there's kind of the requisite support from the seller to ensure that it actually is an eligible cost for purposes of the credit calculation itself. Then the last piece, right, is just overall credit eligibility, right? What that looks like comes in very different shapes and sizes, right? If it's a wind or solar project, right, eligibility is going to be pretty straightforward, right? Because everyone knows that wind and solar projects are going to qualify for the ITC. In the biogas space that I mentioned, there's a requirement, right, that essentially that the biogas producers began construction prior to 12/31/24 to still qualify under historical Section 48, because they likely won't be qualifying under 48E. And so in that case, right, eligibility is really important in terms of, hey, when did they actually begin construction? Do they have the proper documentation around begin construction? Because if they don't, and they happen to begin that construction in 2025, they're likely not going to be eligible to claim the ITC. Similarly, in Section 45Z, I think we're all aware that kind of Section 45Z is kind of the hot item right now because it's new for 2025. There were all sorts of questions around eligibility, computing the CI score, what the ultimate tax credit amount would be for Section 45Z transactions. The good news is that we got some proposed regulations not too long ago that clarified a lot of those questions. There are still a few questions outstanding, but so when we were looking at Section 45Z transactions, in particular, prior to those proposed regulations coming out, just confirming overall eligibility, production, the tax credit amount, et cetera. That was a relatively heavy lift to get comfortable that the actual Section 45Z amount that we were purchasing was ultimately going to be available to the buyer. So again, there are more specific nuanced areas that can be looked at and should be looked at as well. But those are kind of the big ticket items that, tend to be showstoppers in any sort of transaction for a buyer.
Thanks, Brandon. Andrew and Doug, you represent clients on both the sell and buy side. You're specialists in creating legal protections within the transaction documents. Can you walk us through the key legal protections that can be provided in the legal agreements?
Yeah, I can take the next slide here. So legal agreements, and now we've sort of moved into the transaction and we're looking at doing a direct transfer deal for a credit. And so the primary transaction document there is a tax credit transfer agreement. That seems to be sort of the term of art that everybody's settled on, a TCTA. If you're the buyer, you're looking for broad representations and warranties. You're looking for minimal carve-outs. You're looking for minimal qualifiers. The project has been placed in service on this date, period, end of story. The project begun construction on this date, period, end of story. You're looking for reps and warranties about all the things that you expect to be true, about all the adders and multipliers you expect the project to qualify for. The prevailing wage and apprenticeship has been honored at all times it needs to be, and it will be during any recapture period, that the project hasn't been subject to recapture, that there's no third-party finance unless you've gotten a forbearance agreement that's acceptable to you as the buyer. Really, it's your shopping list of everything that you want to be true. Because that shopping list will tie into indemnity, which is our next bullet point. Indemnity comes in probably two primary flavors: at fault and no fault. At fault means that the seller will indemnify you, the buyer, if seller has some fault. Seller's fault would include any representation or warranty being untrue, which is why you want that broad list of representations and warranties to be as extensive as possible, and to look as little like Swiss cheese as possible. The other primary flavor indemnity is no fault. No fault meaning it doesn't matter if buyer or rather seller has done something wrong. If you've got a loss, if you suffer a reduction or a disallowance or recapture in the tax credit, you're going to be indemnified for it. That's the thing that as a buyer you want. You want the no fault indemnity. If what ends up being negotiated is the at fault indemnity, then you want that broad list of representations and warranties. The indemnity, either way, no fault or at fault, is going to be reduced essentially to the extent that whatever the loss is, a recapture, a disallowance, or reduction, is caused by the buyer. So, if buyer fails to timely claim the credit and then can't, you're not going to get indemnified for that. If buyer claims too much, rather more than buyer paid for, you won't get indemnified for that. The other thing that's often negotiated hotly is an indemnity cap. What's market is probably about 110 to 120% of the face value of the credit. As the buyer, you want 120%. We've seen some deals in which people buyers try to push that up to 125%. I haven't seen that come true yet. 120% seems to be about the top end of market. As a buyer, you'd love to get 125%, but in all fairness, 120% is about market. But you want at least that 120%. The reason you want that 120% is that if doomsday happens and 100% of the credit is lost, then an indemnity cap equal to 100% of the credit will make you whole for that lost credit, but it will not make you whole for interest because you claimed a credit and didn't pay tax, and now it turns out your credit was invalid, and so you should have paid that tax, and interest has been running. And so 100% indemnity cap will make you whole for the lost credit, but not for the interest, not for late payment fees, not for the penalties for not paying on time. That's why you get 120%. You want your cap, if you can get it as a buyer, to exclude the gross up. The gross up is the idea that when seller pays you some indemnity, if that indemnity is treated as taxable income to you, a taxable payment to you, you're going to be taxed on it. And so seller is going to pay you $1, and you're going to have to turn around and pay tax out of that $1 to the IRS. And so that $1 really isn't worth $1. The math generally comes out to, including gross up, that for every $1 that you're owed, you got to be paid more like $1.60 or $1.66 to come out whole and actually get $1 in your pocket after you pay tax on the $1 you received. So buyers, you want a high indemnity cap. You want to exclude the gross up. You want the gross up paid separate and apart from the indemnity cap. Don't cap it. That's uncommon. More likely than not, the gross up is going to be included in the indemnity cap. And sellers know the gross up is really sort of the high money, the big ticket item. So that's the one they especially want included in the indemnity cap. Something to be aware of. It's table stakes. Make sure you get the gross up. That should have probably been a bullet point, but it's become so market and sort of such a basic assumption by now that it's not a bullet point. But make sure that your indemnity is grossed up. If you've got tax credit insurance, if you're the buyer, you want to collect from your indemnitor, from the seller first. You want to hit the easy button and just get paid by the seller. You don't want to go through the process of making an insurance claim and the insurance, underwriter and carrier investigating your claim. And then there's a determination of some sort. Maybe you got to challenge it, maybe you're not. Then you wait to get a check and so forth. More likely than not, in any tax credit insurance, the seller is going to be the named insured, not the buyer. And so unless you've got some lost payee language, when one day ultimately a check is written, it flows to the seller as the named insured, who then has got to turn around and pay it to you as the buyer. The easier option, if you're the buyer, the more protective option, is just point at the indemnitor, the seller, and say, pay me. Seller, you go collect from insurance to reimburse yourself if you want, but you just pay me up front. That's your preference as buyer. Get paid by the seller first. Buyers, you also want to collect prior to tax payment, meaning if there's a loss, a reduction, a disallowance, and so forth, you'd like to collect your indemnity from seller before you got to turn around and pay some amount to the IRS, so you don't have to pay the IRS out of your own pocket. The more seller-friendly version, and Doug will hit this on the next slide, is that buyer pays first and then goes to seller to get made whole. So buyer's got to carry that loss for a while and then wait for seller to pay. Your preference is for seller to pay first when the issue arises before you, the buyer, make a payment to a taxing authority for that issue. If seller, financials aren't great and there's no insurance, get a guarantor. Look at those guarantors' financials as well. If seller's financials aren't great, there's no insurance, there's no guarantor, offset your risk by decreasing the purchase price. If your risk that somebody isn't around to stand behind indemnity or somebody with deep pockets isn't around to stand behind indemnity, try to de-risk that by getting a discounted purchase price. There is a nuance sometimes to liability caps, and it's something you want to try to get if you're a buyer, which is that the cap increases for rejected settlements. Meaning, let's say your indemnity cap is 120% of the face value of the credit, which is about market. And you have a chance to settle a claim with the IRS for some amount that's within that cap. And you go to seller, because often seller has to consent to you settling a tax contest if seller is going to owe you indemnity. And so you go to seller and you say, I've got a chance to settle this for 120% of the face value of the credit, and that is the indemnity cap. Please consent. And seller doesn't. Seller thinks maybe you should roll the dice and contest the tax further and you'll get something less. And it turns out seller's wrong. And so you had a chance to settle for at the cap or under the cap, and seller said no thanks. And so you went ahead and concluded the dispute. And it turns out that you owe more money than the cap. Whereas had seller said, yes, you could have settled it at the cap or under. In that case, the cap should increase on a dollar for dollar basis equal to what you end up paying. The theory being, seller, had you consented, we could have got this done at the cap or under. You didn't consent. As a result, the resolution is going to cost me an amount of money above the cap. You need to make me whole for the difference. Is that common? I wouldn't say that's market, but we've been successful getting that on behalf of buyers in a number of deals. And it puts a little bit of pressure on seller to not delay or withhold consent to a settlement. Insurance, we talked through, probably enough already, but when it comes time to negotiate the actual insurance policy as the buyer, you're looking for expanded coverage. You're looking for decreased exclusions. You're looking for the insurer to have to prove that they've been materially prejudiced before they can trigger one of those exclusions and rely on it. When it comes to insurance and when it comes to forbearance agreements as well, which is the final bullet point, seller and buyer are aligned. Both of those things offset liability from both of you. They offset liability from buyer in the sense that insurance is going to stand behind a tax loss, at least to the extent the policy says so. There's not going to be recapture caused by a lender, at least to the extent the forbearance agreement says so. And so on the seller side, that, to the extent buyer's not going to suffer those things, you're not going to have to indemnify those things. So sellers and buyers are very aligned in what they want out of insurance and forbearance agreements. Next slide.
So I'm going to talk about the flip side of this, and I'll probably do it in a bit of an abbreviated fashion because we're running out of time, and Andrew just covered a lot of this. But the flip side is, okay, well, how's seller going to think about these same issues? So buyers are going to be looking for the broadest reps they can. Seller is going to be looking to limit those to the extent that they can. One comment about the representations is that a lot of times in legal documents, people make a big deal about not repping to a legal conclusion in representations. That's done relatively often in tax credit transfer agreements. Then a bit of a commentary on the indemnity. Andrew was talking about the no fault and the at fault. Obviously, sellers would prefer an at fault indemnity. it's as the market has evolved, no fault is probably becoming more and more of a standard, but at fault, you certainly do still see that concept baked in there. And sometimes it's the only way to trigger the indemnity. The indemnity cap itself, typically what the indemnity is, well, every time what the indemnity is going to cover is the amount of the tax credit. It's going to cover interest. It's going to cover penalties, and there's two kinds of penalties that could apply. There is a 20% excess credit penalty, where if you claim a credit is worth $1 million, but it's really worth 80, that difference, that $20 million, you have to pay a 20% tax on that. In addition to any underpayment penalties that the buyer may suffer by the fact that they thought they had enough tax credits for $100 million, but it turns out it's only $80 million. So you got tax credits, you got interest, you got penalties, and then you have the gross up, which Andrew already explained can get very expensive. So what does that mean? Well, it means that 120% cap is really designed to fully cover smaller issues. Maybe the basis numbers were off by a little bit. Maybe the production wasn't quite what you thought it was. And if you have some problem which impacts less than the entire amount of the credit, chances are your 120% cap is gonna be sufficient. If not, if you're dealing with something that just sort of says the credit is not eligible at all, then it's likely that 120% cap is not going to cover all of the damages. So sometimes what you'll see people do is kind of abandon the concept of a cap at all, but they will cap the indemnity, quote unquote, by saying that the indemnity will only cover the categories of damages that I just went through: the tax, the interest, the penalties, the gross up. And costs, I should say, as well. Defense costs are also a part of that. It is obviously the seller wants to get that cap down as low as they can, and they want to collect. They want buyer to be able to collect under the indemnity after it's made the tax payment. There is often a concept baked into these agreements of final determination, such that, the liability to pay the tax, for the buyer to pay the tax and the interest and the penalties, isn't indemnifiable until it's finally determined by the IRS. So it goes all the way through audits, maybe it even goes to court. So that, there's some delay that goes with that. And that's important to keep in mind. As to collecting insurance first, the seller is going to prefer that buyer goes to insurer to collect before coming after the seller. That's not always the way it works in the market. So a very aggressive position, a very seller protective way to do this would be to say, okay, well, first we have to get a final determination from the IRS. That's going to take some time. Now you've got an indemnity claim. Okay, buyer, go to insurance, submit your claim, and wait for them to give you an answer. If the answer is no, and it's a final no, it's gone through any appeals that may be, gone through whatever the process is with the insurer. At that point, seller will step in and indemnify. That's really the most seller favorable way to do it. A lot of times, people kind of split the baby and just say, okay, buyer, submit to insurance first. We'll wait some period of time. Maybe it's a month, maybe it's 6 months, maybe it's longer. And if you haven't gotten an answer from insurance at that point, then we'll go ahead and indemnify you. And then a lot of these, another one which I'll point out, which is a little bit different for seller, and then let us move on to the next slide, is that, if an audit does come up, like Brandon was talking about, seller is going to be interested in having some say in how this audit is done, because they're standing behind it ultimately. So something for sellers to keep in mind is that, the tax contest provisions in these agreements are important, and they want to have consent rights, things like that. That's it on this one. So let's move to the next.
Sounds great. Thanks, Doug. And Mark, on the last panel you and I were on together, we ran out of time. We're closing it on time. But
Yeah, I'm not going last anymore, Faith.
I know. Sorry. You're first next time. We're saving the best for last. Mark, obviously we've heard a lot about insurance thus far. It's a key theme. You're the expert here. You're preparing the submissions, negotiating on behalf of buyers and sellers for the policies. What are some key further considerations outside of what's already been discussed here? And how is it the policy really incorporated into this overall transaction?
Yeah, thanks, Faith. Happy to do it. So I'm going to talk more about the gestalt of what tax insurance is and how it solves the problems, and less about coverages, because I think the rest of my colleagues here hit those a fair amount. So essentially what people have been talking about here is that tax credit transfers are this massive opportunity, but the question that lingers out there is, how do I know the IRS isn't going to come in later, challenge the credit, leave me with a massive liability or a massive indemnity that I need to make someone whole about? And so that's obviously a big friction point for getting these transfers done in this market. So tax insurance is intended to be the elimination of that friction point, giving both buyers and sellers the confidence in to transact with one another. So couple of important points about what tax insurance is and what it is not. So tax credit insurance is, at its very basis, it is a risk transfer tool and a backstop for a buyer's balance sheet and a seller's balance sheet. It covers the losses if the IRS successfully challenges a tax position that was taken in good faith, such as those calculations and things that we talked about earlier. It applies when advisors believe that a position is at least at a more likely than not level of confidence that it is correct, but there is some sort of residual uncertainty that remains, because not everything is certain, and you can't always predict what the IRS is going to attach and attack. So it will cover your disallowed credit, and it will cover any penalties and interest on top of that. But so sitting alongside of what it is really important to talk about what it is not. It is not a substitute for getting solid tax advice. You got to go to these guys on the panel to get your solid tax advice. You need to have complete documentation, and you need to have compliance with the transactions that underlie all of this. Tax insurance is not going to step in if you do not have those things. It will not cover fraud. It will not cover sham transactions. It won't cover negligent filings, and it will not cover if you have known issues that you've misrepresented to the insurer. So the key principle is that the insurers are relying on the same facts and analysis that you are supposed to be comfortable with in your position as a taxpayer. That foundation needs to be solid. So Faith, if you want to skip forward 2 slides, I'll talk about exclusions, which folks are talking about, making sure you trim your exclusions and making sure that they're tailored the right way. And that's true. And that's a very sort of detailed thing that I'm not going to hit a ton of details on, but I do want to talk about what types of exclusions lay out there, right? Predominantly, exclusions are things like conduct-based exclusions for fraudulent acts, material misrepresentations, changing the transaction documents that underlie what you're getting insured, settling disputes without the consent of the insurer and opening them up to having to pay something that they didn't agree to, breaching covenants in your underlying tax credit transfer agreement. Those are all conduct things that can cause your insurance policy to have a reason to not pay out. Another really important thing to talk about is change in law, and a lot of folks out there come to me as a broker and they say, "Oh, I need retroactive change in law coverage." Retroactive change in law is not exactly a coverage. It is essentially a carve out from the standard change in law exclusion. Tax insurance is meant to underwrite a tax position, something that you believe in. It is not political risk insurance. It is about I've done my taxes in the way that the tax code has said I'm allowed to do it in 2025. It doesn't necessarily mean you're going to be able to replicate that in 2026 if the law changes. But it does sometimes mean with certain insurers that if somebody in 2026, if for some reason the IRS the Congress were to go back in time and say that all of your 2025 transactions are no longer valid, the insurers are often willing to cover that because that has happened essentially never in American tax law. And if we hit the last slide real quick, I'll do it in the last minute here. Practical takeaways for folks, right? So insurance is sort of about like the end game, right? You've got your tax credits and you're ready to transact them and you're ready to get some money from it. What's the practical things to do in order to get to that end game? Engage your insurance early when you already have, when you have a term sheet. Don't wait to be a week before you need to close. Quality matters. Make sure that you have good advisors coming in. Make sure that you have good support because that's really critical for the underwriting. And I'll leave it there since we're at the hour.
Thank you, Marc. You still managed to get all the important things covered. We're going to skip the summary because we are at time. And I do want to let you know that we have had questions in our chat, but since we're short on time, we'll make sure that we email all of you directly. One of the panelists, us, will coordinate that and get you responses via email. So at this point, I do want to thank you all for joining us today. Special thanks to Brandon, Marc, Andrew, and Doug for your participation and sharing your expertise with us. A recording of the webinar will be posted shortly to Mickelson & Company's YouTube channel and website. You'll also have it available both from Husch and CLA. And we will also send everyone a link to the webinar recording as well. If you have questions, please reach out to any of our panelists who would certainly be willing to help you in any way. Thank you so much again. Have a great day.